So I think we'll make a start. Good morning, everybody. It's great to see that so many people have joined us today, and a very warm welcome from us all at Hargreaves Lansdown. So today is all about how to get your employees excited about pensions and investment. Yes, I did use excited and pensions in the same sentence, but with the right guidance, there's absolutely no reason why we can't help employees to take more interest in and responsibility for their life savings. So some introductions. I'm Richard Turner and I'm part of the team at HL Workplace. I work with employers providing their employees with modern new pension plans, workplace savings and financial wellbeing programs. I'm thrilled to have three expert speakers here today to share their insights. First, we have Anne Fairweather, Head of Government Affairs and Public Policy at Hargreaves Lansdown. Good morning, Anne.
Good morning.
Hello. Next, we have Emma Wall, Head of Investment Analysis and Research at HL. Morning, Emma.
Good morning, Richard.
Morning to you. And Stephen Lefley, Head of HL Workplace Solutions. Good morning, Stephen.
Morning.
Great to have you all here today. So a brief overview of what we'll be covering today. Anne will take a look at Hargreaves Lansdown's new Financial Resilience Barometer. Next, Emma will be outlining how you can build investment resilience in the face of so much market uncertainty. And to round things up, Stephen is going to explore what roles you as employers could play in helping employees to build their financial resilience. So first we come to you, Anne. What on earth is a financial resilience barometer and why launch one now?
Thanks very much, Richard. And good morning to everyone who's attending. It's great to see so many of you here today. So why launch a Savings and Resilience Barometer? Well, I think at a headline level, I think there's quite a few things that have been driving this. I think first of all, post-COVID, financial well-being and the state of everyone's finances is very much at the forefront of everybody's minds. And if you look at organisations like, say, the Money and Pension Service, they're really focusing on that measure of financial well-being. Secondly, the cost of living crisis is only getting rapidly worse by the day, with sadly this war in Ukraine, but there were energy price shocks before. And I think obviously with inflation on the rise as well, people are really concerned about their personal finances. But in terms of what the government can do about this, it's obviously got limited bandwidth. Its big priority at the moment is trying to level up the country and bring more investment into areas that have been deprived in the past. But there's probably a limit to what they can do for people's personal pockets. The cost of COVID has been very severe on the nation's finances. And then I think it's also worth calling out as well, even if there was more money or more desire to spend more money from central government, government is also incredibly distracted at the moment. Not only was it distracted politically at the start of this year, with all those issues of parties, which I'm quite sure will come back again, it's obviously now distracted by a war in Europe and also those huge challenges post-COVID. So I think, what does that mean for you guys as employers? Well, I think it really means that the government is looking for us all to step up and to play our part. And I'm quite sure your employees likewise will be thinking, what is my employer going to be doing to help me and my resilience? And so to some extent, that was part of the genesis of why we launched this Savings and Resilience Barometer. We thought, we're an organisation that understands a lot about financial planning, about building people's financial resilience. What could we do to help inform that policy debate, bring a bit of illumination to that discussion, but then also with our expertise, with talking to clients, how can we use that information to help ordinary people understand their financial resilience? And that's sort of what drove us to launch this barometer. It's probably also worth highlighting, before COVID and our current issues, there was a substantial financial resilience task force led by Baroness Jeannie Drake that was the initiator of the automatic enrolment pensions scheme, and that declared just before COVID that low resilience is a substantial and widespread problem. And I think what's particularly interesting here is, rather than just focusing on those people in very extreme situations with very problematic debt and so on, I think there was a recognition from this task force that actually resilience is an issue that can affect a much wider group of people. People may have money, they may have good earnings, but they may also have quite severe outgoings or be unable to withstand financial shocks. And so I think there's a slightly more holistic look with this drive towards financial resilience, which, as I say, predates the issues that we're now dealing with today. That task force also suggested that there should be a regular granular measure on financial resilience, which is exactly what we've tried to build here today. And I'll talk you through briefly how we did that. So I think the first part for us was thinking about what's relevant when talking about an individual's financial resilience. And in the summer of last year, we launched something that we called TO THRIVE. And essentially, these are the 5 principles that if you came to us to take out financial advice, for instance, it's the first thing one of our financial planners would talk through anybody looking at their finances, however rich or poor they are. So the first is obviously control your debt. Are you aware of what debt you've got out? Are you able to make those repayments? The second is around protections. What if something goes catastrophically wrong? Do you have life insurance in place? Do you have sickness insurance in place? Can you and your family withstand a shock like that? Thirdly, saving a penny for a rainy day. Clearly, it's been a long-running problem that people don't necessarily have enough cash savings to withstand certain shocks, and obviously a big emphasis on that. Fourthly, planning for later life. Obviously, most people in work now have a pension, but are they saving enough? What more do you need to do? And what are the other potential costs in later life? And then finally, investing to make more of your money. There are, a large number of people in the country that actually have too much money in cash savings when they should be investing for the longer term. And I think that's become particularly prominent with the rise in inflation. Although obviously there are issues with market volatility, which I'm sure Emma will cover off in her presentation. So I think the other sort of driver for this for us is the change in the client base that we're looking at here at HL. Now, obviously, with our workplace clients, you have a much broader range of people through your workforces engaged with us and with through their workplace pension. But across all of our product ranges, we're seeing a much with demographic of people coming to us. The average age of the new client last year was 36. So with those younger clients, obviously people are going to have more financial resilience challenges as they try to start out buying a house, maybe having children, those kind of things that really come at a sort of really strain their personal finances. And I think this graph just really illustrates how different our client base is now than it was 10 years ago. So I think it's helpful to talk a bit more about how we pulled this index together, just so that you're aware. Don't worry, we won't be testing anyone on the science of this. We partnered with an organisation called Oxford Economics, who are real experts in data and analytics and economic modelling. And they took those 5 pillars that we talked about, 5 to Thrive, and then they said underneath, okay, what are the measures that we're going to look at in order to help understand each of these 5 pillars? So, for example, when looking at pensions adequacy, we're not just looking at the value of pension, we're also looking at home ownership in retirement and net financial assets, because those are also contributory to how much you can withstand financial shocks in retirement. So in looking to define each of those sort of measures, we looked at different data sources, such as the Wealth and Assets Survey from the Office of National Statistics. Oxford Economics pulled that information together. They then, made sure that it was representative of the nation as a whole, and then they used their expertise in economic modelling to pull that data forward to the current day in order that we could come up with a sort of measure of the nation's financial resilience, but also be able to drill down whether it's on income groups, whether it's on different age ranges, whether it's on different regions, and really start to understand with a bit more granularity how those different pillars interact and what are the real issues that people are facing today. So I think that leads me to come to this final slide, which starts to look at some of the conclusions here. So we had an overall score out of 100 of the nation's financial resilience of 57.7. It sort of doesn't mean a great deal at this stage, But what we're going to be doing is we're going to be tracking that every 6 months. So I do think you'll start to see a pattern over time where you'll be able to see how different economic scenarios have played out and how that's impacted the nation's resilience. And I think we want to see that as a start of a conversation that will happen and build over a much longer period of time. But I think sort of underneath that headline score, there were some quite interesting findings that came out from the report. So, for example, levels of household debt are actually quite similar across different income groups, but it's those who are in the lower income groups who have a lot more trouble naturally to repay that debt. And so it's much harder for them to control. Secondly, around the protections piece, only 41% of families were found to have combined assets in life insurance that would cover mortgage liabilities and the future costs of living costs of their children. So that's actually very low. In looking at that protections piece, we did look at things such as the types of employers, the types of sectors, and we considered who was likely to take out life insurance on behalf of their employees. Quite often employees themselves don't realise that they have some of these protections in place. It's often something people don't really think about a great deal. And it's something that I think is well worth having a conversation with your employees now, because I think especially post-COVID, that whole sort of what if, things go really wrong, I think that's actually a bit more in the front of people's minds. I think most worryingly from this information in this survey was that only 16% of single parent households had that kind of protection in place. Now, to some extent, it's understandable. Single parent households often have much lower incomes, but it is really critical in a single parent household that prime earner, has the ability to look after their children should something go wrong, should they have, a severe health problem, for instance. And I think that's something, I'm really keen that we look at what are the policy solutions for that, but I think it's also something for employers to hold front of mind as well. Thirdly, around a third of the UK doesn't have access to savings that would cover at least 3 months essential expenditure. So I think we took that bar a bit lower, looking just purely at what is essential expenditure. But there's still quite a long way to go there in terms of everyday savings for people. Even with automatic enrolment, only around 40% of households have got adequate pensions for their retirement. And we use the Pensions and Lifetime Savings Association's measures of moderate retirement income to pin that against. And I think we'll be exploring about how we can see, how people come off against a basic income in retirement and a sort of a more aspirational level of income. But I think to start with, we just looked at that moderate income in retirement measure. And then finally, the number of households who don't hold any investments as well. So that sort of gives you an overall picture of what we found. What you don't have here is our tool, which is online, and I'm quite sure Stephen will mention in his presentation a bit later on. But that's the sort of resource where people can see, people like me of my age, how do they fare? And then it points you to information on all of these pillars. So it's really a financial education piece. It's not about products. It's about just trying to bring forward that understanding around resilience and what we all need to think about in our lives. Certainly, since doing this project, I've been very paranoid about whether I'm personally resilient enough. And I was very pleased to see that our protections at Hargreaves are going up. And I was thinking, I think I might be okay now. So I think I'm reasonably confident to front out this conversation now, but I think it's something actually everybody needs to spend a bit of time thinking about. Thanks for your time. I think we'll be taking questions later.
Many thanks, Anne. It is a bit of an eye-opener, actually. And if you want to try your own, test your own financial resilience, go on to hl.co.uk and search for 5 to Thrive. So I've seen there's a couple of questions I'd like to put to you later. And incidentally, if anybody has got any questions for any of our speakers, can you use the question and answer box, the Q&A box, which is either at the top and the bottom of your screen. So do post those, as we will have a bit of time later on to post those questions. So I'd like to come to you now, Emma, for a look at what has been a pretty turbulent time for investors, and also a look at see what you're seeing coming down the track over the next year or so. So over to you.
Thanks, Richard. And thanks very much, Anne. I agree. It has forced me, even though I work full-time in investment, to have a think about whether I have things like an appropriate cash buffer. So really important educational tool there. So on to markets. Once you have paid down your debt and got an appropriate cash buffer, investments is the next place to go. And navigating volatile markets is really hard to do. I've pulled out some of the headlines that we've all seen over the last year, even before the tragic events of the last week. It has been a pretty busy 2 years for markets. News flow and sentiment really impacts investments. Now, if we lived in a fair world where investments just traded at what we call fair value in the market, that is what they are intrinsically worth, then it'd be a lot easier to be an investment specialist, because you would just look at the fundamentals and you'd be able to tell what will happen to share prices and indeed fixed income prices or bond prices. But that's not always the case. There's something called what we call animal spirits in markets, and that is sentiment, that is fear, that is optimism, that is ambition, and that very much drives market prices as well. Things such as the tragic events of the last week leading to uncertainty. Positive things such as, I don't know if you remember when the stock markets bounced when we all heard that their vaccine had been developed in November a couple of years ago. So these animal spirits, these sentiments drive markets, and they make it difficult to predict returns and difficult to invest. So I wanted to talk a bit about how you can see through some of the noise and focus on the long term and invest in a way that actually helps to mitigate some of these animal spirits, some of these shocks, both on the upside and the downside. So a bit of a recap of what has happened over the last couple of years and the situation as we came in 2022. So despite having that significant market sell-off in March 2020 and continued uncertainty around coronavirus, even a sort of slightly shock lockdown at the end of last year, we actually did have incredibly strong stock markets across the world in 2021, in particular in developed markets, the US, the UK. If you look at a 5-year view, however, despite having that significant sell-off, when coronavirus first kind of hit markets, most markets across the world are up over the last 5 years. You can sort of almost ignore the significant volatility in between, and you're looking at positive returns. But they've been driven by quite a few concentrated areas of the market. I don't know if you saw the headlines. There is a small stock in China called Zoom, which everyone confused with the Zoom that we are using today when the pandemic first hit. And that stock went up something silly like 300% in a day before everybody realized actually it was the wrong Zoom, and then it sold off again. But those areas of the market which have benefited from this actually permanent change in the way that we work, we operate. Webinars like this are a permanent fixture now, where previously we perhaps wouldn't have considered them. So there are areas of the market driven by demographic change, driven by lifestyle change, driven by technological advancement that have really led the markets up over the last 5 years. So the performance has been positive, but as I said, it's been concentrated in a few sectors, which has led to some stretched valuations, some stocks trading perhaps on more than they are fundamentally and intrinsically worth. So that was the situation coming into 2022. Also, inflation expectations, as Anne touched on, the cost of living has risen significantly, fueled by supply issues, so trade restrictions over the last couple of years, and a commodity rally. I'm sure you're all aware of the energy price cap lifting next month and the impact that will have on households. But that's not just the case in the UK. Across the world, inflation has been rising. And central banks across the world have been responding to this by raising interest rates. So New Zealand was one of the first to go last year for the rates for the first time in over 7 years, and signaled that it was going to raise rates another 4 times through 2022. The US has done the same. We've done the same here in the UK. Europe has steadfastly said that they're going to keep rates actually low as they have been, but there has been some sort of wobbles around the edges that they might abandon that policy and raise rates as well. And that impacts investment markets because the types of stocks that do, and indeed bonds that do well in a rising rate environment, are different from the ones that have done well in a falling rate environment, which we have seen over the last decade. And actually, really broadly, over the last 30 years, interest rates have been coming down. And so that meant that markets underwent what we call a style rotation, which is when one part of the market which has been doing very well flips to another part of the market which has not been doing so well. And this was driven by that interest rate change. If you think about the types of stocks and companies that might do better in a higher rate environment, it's things like banks, which have been suffering because of the lower rate environment. So this style rotation happened through January, and we saw quite a lot of market turbulence because of that expectation of higher inflation, higher interest rates, because of that, those stocks like Zoom having done so well coming down a bit. And then, of course, in recent weeks, Russia has declared war on Ukraine, and that has impacted the markets, creating a lot of uncertainty. So what next? If I had a crystal ball and could say exactly what would happen next, I probably wouldn't be on this webinar. I'd probably be on an island somewhere in the middle of the ocean sunning myself. But we do have some idea about what's going to happen this year: greater inflation, higher interest rates, and with that, greater volatility. So greater market shocks. I mean, we've seen some incredible moves so far this year. Funds, which traditionally are much sort of a smoother investment, have been moving as much as 10% in a day because of this greater level of uncertainty. And because we're seeing this unwinding of that market trajectory that has been going for so long, with that sort of dominance of those growth tech stocks really changing and then not doing so well. Commodity prices are also likely to continue to rise because of supply and demand, and also gold. It's one of the areas that on our platform we've seen many of our clients buy over the last month, and in particular over the last week, because it is perceived as a safe haven. So it is one of those asset classes that when there is uncertainty, the price does tend to rise because of demand. And bond markets reversing that 30-year trend. That's, interest rates have been broadly coming down over the last 30 years, and now we're actually in an inflection point where they are rising, albeit to more modest levels than perhaps we saw in the 70s, but they are rising. So how do you invest in a market where there is that much uncertainty, there is that much volatility, and there is this great style rotation going on underneath markets? Well, diversification is key. And what do we mean by diversification? We mean investing in different asset classes, so stocks, bonds, gold, alternatives, different parts of the world, spreading your investment over different geographies, and indeed different styles, to that point I was making earlier, having a mix of growth, value, momentum, having larger caps and larger companies and smaller companies in your portfolio, because different types of investment perform well in different types of stock market and different types of economy. So taking some examples here, you can see that there's gold. Don't worry, much like Anne, I'm not going to test you on all of these. This is just an illustrative point to see all the different flavors that you can put into a well-diversified portfolio. We leave that to professionals. But you can see things here like global inflation-linked bonds in the bottom right-hand corner. Those are bonds that perform in line with inflation. So as inflation goes up, so do your investments. You can also see gold at the top of that column on the top right. That, as I said, is perceived as a safe haven asset, which means it tends to do well when there's a lot of uncertainty about. Equally, you can see in the towards the left at the top, UK equities. That's UK listed companies. Now, they tend to do well for two reasons: when the UK economy is doing okay, but they also provide in and of themselves a bit of global exposure, because 70% of the revenues of the FTSE 100, so that's the largest 100 companies in the UK, their revenues come from global sources. So the point being, think of it like quite a complicated recipe with lots of ingredients that delivers a delicious cake at the end. And the other thing I wanted to talk about in terms of risk mitigation and helping you focus on the long term and deliver long-term returns through some of that uncertainty is environmental, social, and governance factors. So you've probably heard quite a lot about ESG. It has been an extremely popular topic over the last couple of years. The way that we think about it at HL is it's just simply good risk management. So environmental factors potentially are a risk to your returns, as are social factors, as are governance factors. And how do these risks sort of materialize? Well, they may come in the form of regulation. You don't want to be invested in a company that potentially might get hit with a massive fine by the regulator. You don't want to be invested in a company that customers are going to be turned off by because they actually don't like the way that they do business or their practices, be that child labour or even things like having a fair inclusion and diversity policy at that company. We actually have started to see in Europe, particularly in the Netherlands, graduates have started to ask companies what their ESG policies are before they even go and work there. So there's even a potential conversation about whether you're going to get a sufficient pipeline of employees if you're not a good ESG company. So these threats to returns, as I say, can include competition, regulation, technology, cancel culture, government restrictions. They're all disruptive forces, which is why we think investing in good businesses that have, solid environmental, social, and governance factors built in means that you're investing in businesses that are sustainable revenues, sustainable profits, and sustainable dividends. So that combination of good risk management with ESG factors and diversification in your portfolio should ensure that over the long time you can weather some of these market shocks. Bit of a plug here, but the HL growth, the new workplace default, has both diversification and ESG factors built into the investment process.
Emma, thank you very much. It was a fantastic insight as always. And one quote that sticks with me is that invest for decades, not days. And I think it's very easy to get caught up in the ups and downs daily if you're not careful. But of course, for the vast majority of people on this call today will have employees who are in the default fund. And I can see a question that's come in that I'd like to put to you later on around that as well. So certainly be coming back to you in due course. And that brings us quite nicely to you, Stephen, and how all this applies to our audience's employees. So how concerned should employers, especially those people who are on the call today, maybe in HR roles who are responsible for their employees' well-being, how concerned should they be about the state of their employees' financial resilience?
Very is probably the quick answer, Richard, and morning everybody, and thanks for joining us. Thanks for the intro as well, Richard. So yeah, before we go on to my slides, and I've only got 5 to finish off with, this is about drilling down into Anne's section and looking at some practicalities for you here. So I'm hoping that following Anne's section, you're thinking along the lines of, yes, we already know that poor financial resilience affects the bottom line. We already know that. And we know that we've got a part to play in helping employees to improve things. But you're hopefully thinking, what really matters and what can we do about it? How can we do it? So how can we shift the needle? Do you like that animation? So yeah, how can you shift the needle? And so over the next few minutes, I just want to provide you with some answers and some practical considerations. And importantly, without you all needing to go cap in hand asking for extra budget. So let's move on to my first of the 5 slides. So this one will recap. If we look at the left-hand side, some text will appear that just recaps what you already know. Poor employee financial resilience really is an employer issue. And there's thousands of statistics that kind of evidence that people don't leave the financial worries at home, they take them to work with them. I've just extracted these numbers from a single survey that was actually done by Close Brothers in 2020, but there's a million statistics to choose from, and they're all pretty similar. So they've attempted to quantify the effect of financial stress on the corporate bottom line. It's very clever how they did that. They're big numbers. Whoever measures that 17.5 million hours have been lost in economic value to financial stress is pretty smart. But the bottom two statistics can, as Anne and Emma have both pointed out, those bottom two statistics can have only increased. If back then 42% of people were losing sleep due to money worries, I bet that in recent weeks that number has increased quite significantly. And it would be interesting to see the next set of measurements. And clearly, more people are worrying, more employees are worrying about their financial health post-COVID. So then we go to what the ask was. And again, some of you will have seen the letter that arrived almost exactly a year ago, so March last year, from the government. So most large and medium-sized employers received this ask. And without reading the whole letter to you, because I haven't got time, if you look at the bottom highlighted sentence there, specifically the government was suggesting that payroll facilitated savings mechanisms were introduced via the workplace. And of course, that's absolutely possible. And it's a trend that we're only just starting to see begin. So the point there being that people can then save before they even have the opportunity of spending. It's just one step removed from money being readily available in a current account. So moving on, that's the issue and that's the ask. So now if we go back to Anne's presentation, and we link all of this with the savings and resilience barometer that Anne described. So what differences practically can be made from within the workplace? Well, I think really we just need to focus, for the purpose of this session, on the employee benefits perspective. And if you just pluck out the features of a comprehensive employee benefit package, the barometer needle can shift by up to 40%. And that's if you make appropriate benefits available, and of course the employees then embrace them. They know that they're there, they understand what they're for, and they actively participate in them. So looking on the left-hand side of my chart, 3 of Anne's 5 to Thrive categories are relevant here. Saving, protecting, and later life, all prevalent in a comprehensive employee benefit package. So within savings specifically, a payroll deducted savings or investment account, i.e. akin to the government ask, will enable an individual to save before they can possibly spend. And having one of those in situ can shift the barometer needle by up to 11%. And that's if 3 months expenditure is accrued in a savings plan. Then in the protection arena, we've got 3 vital products there. So life insurance, again, as Anne's described, critical illness, and income protection. I personally have been the beneficiary of a group income protection plan. And I just know how mentally necessary that is when you're recovering from a major accident and you're wondering whether you'll ever be able to return back to work and you need to focus on mending. So these things are really important. And if you have those 3 items, those product sets within your package, then there's another 18% there to be had in terms of the barometer gauge. And retirement planning, the workplace pension, again, Anne's already covered it, but if it's sufficiently engaged with, obviously we've all got the ability to join one or to be auto-enrolled into one, but if it's sufficiently engaged and funded to the PLSA moderate standard, then that can add the remaining 11%. You sum all of those up and you've got 40% there. So that's the difference that the compensation and benefit package can make. So step 1 is about making the essential products available. Step 2, of course, is about encouraging employees to embrace and adopt them. So, it's like you can lead the horse to water, but can you make the horse drink? Well, we're getting pretty good at making the horses drink, actually, as a provider and probably as an industry. So some service providers can measure employee engagement these days. We do at HL. And we can provide management information to employers for scheme governance purposes. But getting the employee response to where it needs to be requires people. It's not just about technology and websites. Of course, they're essential, but it requires influencers. And this slide's an example, really, of how HL makes financial education impactful. So if you look on the left-hand side of this graphic, we make 19 educational modules available. And quite simply, it means that you can focus on a specific topic, and the audience, because it's a specific topic, the audience are going to be interested enough to sign up to it. It's not a one-size-fits-all, basically. They sign up, they attend, and then they learn, as they've decided that the topic's relevant to them. But if you look at the middle column, of course, over the last couple of years, we've had to learn new ways of working. We could have just stopped educating everybody, but we haven't. We've learned how to use technology like this. And so the education hasn't stopped, we've just evolved it. And now we've got the new hybrid people and video capability to use going forwards. We can reach a far wider workplace / home audience to the tune, and we've measured it, of enhancing coverage by an extra 42%. So it's huge. We didn't want to learn this, we were forced to learn it, but there's clearly benefits to be had. And then we've looked at exit polls. So we ask employees to score sessions out of 5 for content understanding and quality of one-to-one meetings, for example. And if anything, quality's increased using the hybrid media, it hasn't reduced. So yeah, so that's kind of the how, the human touch, as I've called it. So if we move on, Richard, to the penultimate slide, going back to the beginning, I said I'd show you a way of increasing financial resilience without you going cap in hand for additional budgets, because that's easier said than done, isn't it? So, I call it squeezing the balloon, as my colleagues will know, but it's best described using this example, which is going to be applicable to some of you, probably not all, but some of you. So the silhouette employee here joined her employer. Her employer has a workplace pension scheme, surprise, surprise, offering a compulsory core contribution and an employer matched contribution structure. So as you can see from the top line, under the bold heading employer employee, she has to pay 4% to be a member and the employer pays 5%. You can see from the table there, if she pays 6, the employer will pay 7. And then that steps up to the fact that if she pays 8, the employer will pay 11. So guess what she wants to pay? Of course, she wants to get 19%. 9% top line turns into 19% total. And it's only going to cost her another 4%. So that's what she wants to do. But of course, she's got a dilemma. She can't overcommit herself. She's got the priorities the same as all of us that are closer to the now. And she's pretty young, looking at that silhouette anyway, and locking away her money for 30 years is a huge ask. 30 years, that's incomprehensible, isn't it? You're never going to get to 55 and 57 or 58, 60 years old. That's just incomprehensible for somebody that young. So there's a simple way to solve the dilemma, really, and to improve her financial resilience. So I'll put some additional graphics on this slide. So what we could do here is we could use a simplified, let's just imagine it as a simplified flex benefit system. It presents her with the ability to apportion the non-core pension contributions to other payroll facilitated products. So in this example, the payroll ISA and the payroll funds and shares accounts are a popular choice. So the employee makes her choice, she accepts the product terms and conditions, and she then has the ability to save before she can consider spending. So yes, it's a voluntary product, but it's the take-up. We've tested this, and the take-up is surprisingly high. And it's high because, of course, there's the employer subsidy. We also were nervous about the propensity to withdraw funds. So the money goes straight in and comes straight back out again. But actually the money tends to stick. People do tend to save it and only withdraw it as and when and if they need to. But the beauty of it is, of course, is that when resilience is called for, people have the means of accessing it, so the funds are available. So the product architecture, so I know I'm talking about somebody extremely young here, but the product architecture is equally, if not more, applicable to higher earners who aren't necessarily financial resilient, as Anne pointed out earlier, and also who might be obstructed by pensions, annual and lifetime allowances. And this is a better alternative than potentially just a cash in lieu. So in summary, one more slide here, the employer has increased, so it's a win-win basically, or win-win-win-win, there's 4 circles. But the employer has increased the resilience of its employees by up to 40% by simply fine-tuning the compensation and benefit package. Employee productivity has increased as financial worry and stress reduces. The employees better engage and appreciate a balanced savings and retirement offering. And that's the key word, appreciation. They don't always appreciate an employee benefits package, but I bet they will if they can see something as close to the end of their nose as a wider savings proposition and not just the pension. They don't have to imagine and discard thoughts of life in 30 years' time. And then finally, it's a job seekers market just now. It's probably certainly something you don't need me to be telling you. But the employee benefits need to be valued as real contributors to total reward. And if you crack that, you're highly likely to improve your employee retention statistics. So thank you very much for listening, and I'll hand back to Richard.
Stephen, thank you very much. And we do actually have some time for some questions which have come in as well. So Anne, can I come back to you? There's a question here about financial resilience. Should employees prioritise building short-term financial resilience over long-term pension investment?
Well, that's the tricky one, isn't it? And I think it's only really come to light with automatic enrolment that everybody is consistently putting that money into their pension, but their day-to-day earnings, not their day-to-day earnings, rather their day-to-day expenditures will go up and down. And so people do need to look at that potential trade-off. I think the one thing that's very important for people to understand is the power of compact. So the power of the investments and the way in which that will build over time. And so if there is a way, for example, to reduce expenditure in the short run to build up that day-to-day savings and that resilience, that is absolutely preferable to taking money out of the pension. So I think that's something an individual needs to sort of work through for themselves. But yeah, you don't want to lose that savings habit for the long term.
Yeah, absolutely. Thank you. Thanks for that. Emma, an investment E1. Should employees be changing pension investments in light of recent events?
I mean, first and foremost, I think it's important to say that our thoughts are with those who are personally impacted by the events going on in Eastern Europe at the moment. In terms of investment, your exposure to Russian stocks is likely to be extremely small. Even if you invest through an actively managed portfolio, the average sort of holding is extremely minimal. And indeed, through a passive portfolio, Russian stocks make up a very small part of the index. And so the investment risk is likely, in terms of direct exposure, to be extremely minimal. That said, it obviously is causing broader volatility, which is managed through the discussion that we had earlier. It's very difficult to put the news to one side and sort of focus on the long term, but especially with an investment such as your pension, which is a multi-decade horizon, that really is the best course of action.
Brilliant, thanks, Emma. Stephen, one for you. Do all pension providers offer workplace ISA? Is that something easy to implement?
The answer is no, they don't all. I'm sure that more and more will be doing so as time goes by. We do at Hargreaves Lansdown. And is it easy to implement? Yes, absolutely. Especially when implemented in conjunction with the simplified flex offering, because of course you can't auto-enroll into a workplace ISA. So there needs to be a means of employees making the decision, accepting terms and conditions, signing up to the product. But yeah, once it's set up, dead easy, because yeah, you're saving before you spend. Unless you look at your electronic pay slip every month, you kind of soon very quickly forget that you ever had the money in the first place.
Great, thank you for that. And one more for you. How will understanding the nation's financial resilience actually help my employees?
Well, I think for us, this is just the start of quite a long-term research project, much like your employees' savings. We're in this for the long term. I think the other thing to probably highlight is we were really excited last week to make a really significant announcement in terms of the investment into our IT, into our data analytics, and a huge part of this investment will go into something we're calling augmented advice. Well, we'll be looking at ways in which we can tailor more information to more people as part of a sort of tailored guidance journey. And that financial planning piece, building on this barometer, will be part of that. So watch this space. There will be more to come in the coming years. But I think it's really for us the building block to start to understand not only the nation's finances, but also all of our individuals' finances. So this is sort of our sort of jumping off point to help improve people's understanding of their resilience.
Yeah, it's exciting times. I talk to a lot of HR people who are responsible for their wellbeing programs, and until quite recently, mental wellbeing, we had a tick against it. Physical wellbeing, social wellbeing are all being done reasonably well, but there's a kind of a gap when financial wellbeing is mentioned, because maybe difficult to access or it's expensive. So yeah, there's certainly a gap there to be filled. And the link between financial stress and mental stress is absolutely key in this. People are stressed about their money. They're not going to be doing their job as effectively as possibly they could. Stephen, just one more for you, if I don't mind, because I'm conscious of time. Isn't contributing, I'm sort of paraphrasing a longer question that's come in, isn't contributing to an ISA much less tax efficient than pensions?
Well, for a basic rate taxpayer, it's a 6 and 2 3s, isn't it? I've seen the maths either way. I won't explain it now because most people, I guess, will understand that. For a higher rate taxpayer, clearly a pension's more tax efficient. But I suppose the point is, it doesn't really matter, does it, how tax efficient something is if you can't get hold of it for 30 years and you need to. You go through your life, don't you, making a balance of investment decisions and savings vehicle and product decisions. So I think the penny's dropping. You have to build financial resilience for now. You can't just think about the future. You can't just think about 30 years' time. You've got to think about the now. And it's not all about tax efficiency. There's a balance to be had.
Yeah, priorities, objectives, what you want for you and your family now and in the medium and the longer term. So I'm afraid that's all we have time for. If you have posted a question that we didn't get around to, we'll actually get back in touch with you on a one-to-one basis and answer that for you. So we'd love to hear from you as well. In fact, straight after the webinar, you'll receive a feedback survey. So if you wouldn't mind taking a couple of minutes to complete it, then we'll know what you've liked and potentially listen to ideas for future webinars. If you'd like to get in touch, please do zap the QR code on your screen now. Give us a call, email, or visit our website or our LinkedIn page. So thank you very much for joining us. Thanks again to our speakers. Stay safe and have a great day.